Avoiding financial pitfalls, lessons from 2026. Most people don't lose money because they're unintelligent. They lose money because they underestimate risks. 2026 has made one thing very clear. Speed of information is accelerating. Volatility is normal. And emotional decisions are expensive. Today, we're breaking down the real financial pitfalls people walked into and how to avoid repeating them. This is not hype. This is not strategy. Mistaking momentum for stability. Part 1. One of the biggest mistakes in 2026 has been confusing momentum with durability. Markets move fast. Crypto rallies hard. Tech stocks spike quickly. Narratives explode overnight. But price movement is not the same as strength. A rally doesn't mean stability. A viral trend doesn't mean longevity. A hot asset doesn't mean it's safe. The lesson: don't buy based on motion. Buy based on the structure. Ask first, is this asset cash flowing? Is it fundamentally strong? Is there long-term demand? Or am I chasing noise? Momentum without fundamentals creates fragile portfolios. Ignoring liquidity. Part 2. In uncertain environments, liquidity matters more than net worth. Many people held assets that looked impressive on paper, but had no access to real cash. Illiquid real estate, over-leveraged positions, locked staking, long lockup investments. Then volatility hits. Unexpected expenses arise. Opportunities appear, and they can't move. Liquidity is flexibility. Flexibility is survival. In 2026, the financially stable weren't always the wealthiest. They were the most liquid. Lesson: keep reserves. Avoid locking everything. Cash is optionality. Over leveraging during optimism. Part 3. Leverage amplifies outcomes. In rising markets, leverage feels genius. In falling markets, leverage feels catastrophic. Some individuals borrowed against portfolios. Some maxed out business credit lines. Some overextended on lifestyle upgrades. When conditions tightened, margins shrank. Debt became pressure. The lesson from 2026: leverage is a tool, not a strategy. Use it for productive assets. Avoid it for consumption. If your income drops 30%, can you still operate? If not, you're over leveraged. Underestimating interest rate impact. Interest rates affect everything. Mortgage affordability, business loans, startup funding, stock valuations, consumer spending. Many people built financial plans based on low rate assumptions. When rates stay elevated longer than expected, pressure builds. Higher rates compress profit margins. They slow spending. The lesson: build projections using conservative assumptions. If rates stay high, can you survive? If borrowing becomes expensive, can you adapt? Plan for friction, not perfection. Emotional investing. Emotions move markets. Fear causes panic selling. Greed causes overbuying. Herd mentality creates bubbles. In 2026, narratives spread faster than analysis. Social feeds influence trades. Short-term gains distort long-term strategy. But financial stability requires emotional discipline. Before making any financial move, ask, is this decision based on data or dopamine? Financial maturity is restraint. Lack of diversification. Concentration builds wealth. Diversification preserves it. Some individuals went all in on a single asset class. All crypto, all tech stocks, all real estate, all small business revenue. When volatility hits one sector, concentrated portfolios suffer. Diversification isn't about fear, it's about resilience. Balance, growth assets, defensive assets, liquid reserves, income producing assets. That balance prevents catastrophic drawdowns. Ignoring personal cash flow, part 7. Many people track investments. Few track personal burn rate. Inflation pressures daily expenses. Subscription creep adds up. Lifestyle upgrades become permanent. If your expenses rise faster than your income stability, risk increases. Lesson: control fixed expenses. Keep operating costs lean. Build margin into your life. Margin equals breathing room. Not investing in skill and positioning. The strongest hedge in uncertain times is skill. Markets fluctuate, industries shift, but valuable skill sets compound. 2026 reinforced the most secure individuals weren't the ones with flashy portfolios. They were the ones with transferable expertise, digital leverage, audience ownership, high demand capabilities. If your income depends on one employer or one platform, risk rises. Diversify income streams. Build digital assets. Strengthen positioning. Confusing activity with progress, part 9. Busy does not equal profitability. Many entrepreneurs stayed active, constant content, constant branding, constant pivoting, but revenue didn't scale. The lesson: measure output, not effort. Track revenue per hour, return on capital, customer lifetime value, cash flow stability. Financial growth is measured, not assumed. The strategic framework moving forward. Here's how to avoid repeating pitfalls. Maintain liquidity. Avoid emotional leverage. Track capital allocation. Diversify intelligently. Reduce fixed obligations. Invest in durable skills. Build assets that produce recurring income. And most importantly, think in cycles. Boom cycles create overconfidence. Tight cycles reward discipline. If you survive tight cycles, you dominate expansion cycles. Financial pitfalls aren't random. They're predictable. They come from overconfidence, overextension, overreaction. 2026 has been a reminder that stability isn't about chasing highs. It's about managing risks. The goal is not to win every trade. It's not to time every market. The goal is to stay in the game long enough for compounding to work. Avoid the pitfalls, control risks, preserve liquidity, think long term. That's how you move forward stronger.